Hey everyone, welcome back to the channel. Today we're going to take a look at Square. We'll do a series of videos on them this week and we're going to start just calculating their WACC. And then we'll move into kind of looking at some of their revenues and then we'll build out a full DCF in a series of videos. So first thing here is I've thrown together their WACC and I get a weighted average cost of capital of 15.7%, which is pretty high. I think this is the highest WACC I've came across yet in my valuations. And this is based off the CAPM model. So, right, we take market value of equity, 101 billion, market value of debt, 2.6 billion, and this is coming from their 10K. I have a debt schedule here, so it's page 121. So you can, you could go look at their 10K and look at page 121. Cost of debt, 4%. If you read through, they have effective interest rates. A lot of their debt is convertible, so it converts into equity, but they have effective interest rates that they calculate for it. So that gets us about an average cost of average cost of debt of about 4%. And then we calculate the cost of equity using CAPM. If you're not familiar with this, you could follow the formula and cell C13 here. A quick search on the internet would explain what CAPM is, but Treasury yield, click the link here, that'll take you to the Treasury website and show you the most recent Treasury prices. And you'll see that Treasury rates have actually been going down the last couple of weeks. Expected return to market, 8%. I think I actually read something the other day that said people are expecting the market to return closer to 6% in the next decade or so, but I still use 8% just because that's the historical return of the S&P 500 since it's had 500 companies. And then the last thing we need to do is calculate the beta. So if we go over to the beta template tab, you can see how this is calculated. You're just going to drop in adjusted close price for the last 5 years by month for the stock you're looking at, and then the index you're comparing to, and then over here it calculates the beta. So you could follow this. And this data comes from Yahoo Finance. So if you go over to Yahoo Finance, you type in a stock ticker, go ahead and hit historical data. And then you can just click here, go 5-year, frequency, monthly, apply. You'd hit this download button and you can download the data. So this is really the first video. So what this is telling me is that Square is a pretty risky company. My gut is telling me they're probably pretty overvalued just from the preliminary research I've done. We can see $101 billion market cap, and if we look at their 10K, they're doing about $10 billion of revenue. So that would imply a 10 times multiple. The reality is their revenue is grossly overstated from what they call Bitcoin revenue. And I think this is a fun little accounting trick to make your revenue look like it grew 100% year over year. If you exclude this Bitcoin revenue, they really grew 17%, which is still good, but it's not 100%. And I'll talk more on this on the revenue video, but I was like reading through this and I was like, what the heck's this Bitcoin revenue? And basically they just record when an individual on their Cash App buys Bitcoin, they record that entire transaction as revenue. So they're saying we're working as the middleman. So we buy the Bitcoin from a marketplace, and when we deliver it to the consumer, if they're paying $50,000 for Bitcoin, we're going to record sales of 50,000. But then we're going to record the direct cost of Bitcoin as a cost of goods. So if you come here, you'll see 4.47 billion in costs of Bitcoin and 4.57 billion in revenue. So in reality, that's about $100 million of revenue, but they're recording the full dollar amount and then offsetting it with the cost. So it inflates the revenue. So this will be a fun one to look through and model out, but my gut's telling me they're probably grossly overvalued. And, maybe a handful of folks got excited when they see 100% revenue growth, but 100% revenue growth with a 1% margin on the main driver isn't really much revenue growth at all, right? That's just giving out something for cost basically, and then yeah, so this will be a fun one. Anyways, I think there's a lot of risk here. I think this 15.7% is probably pretty accurate, but we'll dive deeper into it and kind of dig in, and maybe there's some hidden gems in here, but we'll see. So thanks for tuning in. Let me know if you have any questions or comments below, and I'll try to get back to you when I have time. Thanks so much.